All right. What is up, tycoons? What's up, traders? Super excited for today's video. We're going to take a look at 5 high dividend yield companies to generate extra income and reduce portfolio volatility. Now, companies that offer an attractive dividend yield and have a low beta factor can help you generate extra income while contributing to decreasing portfolio volatility. In today's article, I'll introduce you to 5 companies that can help you to increase your additional income via dividends while providing your investment portfolio with more stability. All of these companies pay a dividend yield above 3%, have a payout ratio below 60%, and a relatively attractive valuation. Now, of course, none of this video is meant to be considered as legal, financial, or investment advice. This is simply for informational and educational purposes. Trading in any stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. Now, be sure to read through the full disclaimer. We'll go ahead and hop right into the video. And now, from my point of view, companies with a low beta factor are more important for, or not more important, but they are important for any investment portfolio. This is because they can help you to stabilize your portfolio in times of a stock market decline or stock market crash. We're going to introduce you guys to 5 companies that can provide you an attractive dividend income and which at the same time can help you to decrease the volatility of your investment portfolio. For each of the selected picks, we'll take a look and make a projection of the company's dividend yield on cost in order to show you how you could benefit from the steadily increasing dividend payments when investing over the long term and not just speculating over the short term. And we included companies here that at least fulfill the following requirements. They have a market cap over 5 billion, dividend yield over 3%, payout ratio is less than 60%. The forward PE ratio is less than 30, and the beta factor is less than 0.9. And these right here are going to be the 5 high dividend yield companies that can help you generate extra income and reduce portfolio volatility. We have Cisco, ticker symbol CSCO. We have CVS Health, CVS. All right, we have Kellogg Company, ticker symbol K. We have Kraft Heinz, ticker symbol KHC, and then we have Toronto Dominion Bank. Okay, so let's dive into these a little bit more and go into Cisco right here. Now, Cisco was founded in 1984 and has a current market cap of 192 billion. The company has a payout ratio of 44.19% and has shown a dividend growth rate of 4.98% over the past 5 years. It pays shareholders a dividend yield of 3.31%. All right, and that is actually stands higher, 101.21% above the sector median of 1.65%. At the same time, it lies 9.79% higher than its average dividend yield over the past 5 years. Cisco Systems' 24-month beta stands at 0.79, which supports the thesis that it can contribute to reducing the volatility of your investment portfolio. In addition to that, the company's free cash flow yield currently stands at 7.96%, which lies 95.76% above the sector median and indicates that it's an appealing choice for investors when it comes to risk and reward. And in addition to that, the company has a PE gap forward ratio of 15.78, which stands 30.31% below the sector median. The company disposes of a relatively strong financial health, which is underlined by its EBIT margin of 26.58%, which is 470.3% above the sector median. Its financial health is further underlined by its ROE of 27.92%, which stands over 2,000% above the sector median. Even though it is true in terms of profitability, Cisco Systems is clearly behind other companies from the IT sector, such as Microsoft or Adobe. It can be stated that the company has a significantly lower valuation. While Cisco's current PE ratio stands at 15.78, Microsoft's is around 32, and Adobe's is 31. However, it should also be mentioned that Cisco's growth rates are significantly lower, while the company's revenue growth rate is 5.71%, Microsoft's is 11.82%, and Adobe's is 11. Below, you can see more right over here, and you can take a look at some of the different Seeking Alpha profitability, grade, and underlying metrics. Okay, and if you want to screenshot this and just dive a little bit further into that, we'll go into the next slide now, and we'll take a look at the projection of Cisco Systems dividend and yield on cost. All right, and so here we can see a projection of Cisco's dividend and yield on cost when assuming that the company would be able to raise its dividend by 4.5% over the following 30 years, which is in line with the company's dividend growth rate of 4.98% over the past 5 years. Okay, and so essentially that's what we're looking at right here, and you can see that this has been a nice steady growth over here. All right, and we're going to look to see this, continue to rise, basically, assuming an average dividend growth rate of 4.5% over the next 30 years. Okay, now this is CVS. All right, CVS Health Corp provides health services and operates through the following segments of healthcare benefits, pharmacy services, and retail/LTC segments. The company has 295,000 employees and a market cap of around $88 billion. It pays a dividend yield of 3.51%, while its payout ratio stands at a relatively low level of 25.8%. The company has a dividend growth rate of 2.92% over the past 2 years. These metrics confirm the investment thesis that the company can be an adequate choice for those investors looking to combine dividend income with dividend growth while reducing portfolio volatility. The company's 24-month beta factor of 0.55 confirms that the company can contribute to reducing the volatility of your investment portfolio. I believe that the company is currently undervalued. Its current PE ratio of 9.42 stands 65.16% below the sector median, and it is 38.21% lower than its average from over the past 5 years. Below, you can find the consensus dividend estimates for CVS Health. The consensus yield is at 3.52% for 2023, at 3.75% for 2024, and 3.97% for 2025. Next, you can see the Seeking Alpha dividend grades for CVS Health Corp, which support the theory that the company is appealing for those looking for dividend income and dividend growth at the same time. The company receives an A rating for dividend yield and a B- rating for dividend safety, dividend growth, and dividend consistency. Now, this is a projection of CVS Health Corp dividend and yield on cost. All right. This is assuming that the company is going to be able to raise its dividend 2.5% per year for the following 30 years, which is in line with its dividend growth rate over the past 5 years of 2.92%. All right. We'll go into the next one here and take a look at Kellogg. Now, Kellogg Company manufactures and markets snacks and convenience foods. The company was founded in 1906 and has 30,000 employees. Currently has a market cap of around $24 billion. The company currently pays shareholders a dividend yield of 3.37%. Its current dividend yield stands 37.16% above the sector median of 2.45%, while Kellogg Company's current free cash flow yield of 4.3% stands 7.71% above the sector median of 4.05%. The company's payout ratio of 55.56% strengthens the belief that it should be able to provide shareholders with increasing dividends in the years ahead. Below, you can find the consensus dividend estimates for Kellogg Company. The consensus yield is 3.14% or 3.41% for 2023, 3.51% for 2024, and 3.62% for 2025. These dividend estimates further increase the confidence that the company can be an attractive pick for investors aiming to combine dividend income and dividend growth, while at the same time reducing the volatility of their portfolio. The company's 24-month beta of 0.26 strongly indicates that you can reduce portfolio volatility by including it in your investment portfolio. Their current PE ratio stands at 17.88, which lies 12.21% below the sector median of 20.37, thus indicating that the company is undervalued. And here we can see a projection of Kellogg's dividend and yield on cost when assuming an average dividend growth rate of 1.5% over the next 30 years. And that is being in line with the company's dividend growth rate of 1.89% over the past 5 years. Even though the company's dividend growth is relatively low, I believe it can still be a good choice for your portfolio if you'd like to reduce its volatility. However, if you decide to include it, I would only underweight it due to the company's limited growth perspective. Kellogg has an average revenue growth rate of 1.63% over the past 5 years. Now, Kraft Heinz is another one. They manufacture and market food and beverage products. The company was founded in 1869 and has 37,000 employees. Currently has a market cap of $49.3 billion. At the company's current stock price of $39.34, it pays its shareholders a dividend yield of 3.98%. The company's current payout ratio stands at 55.94%, indicating that there shouldn't be another dividend cut in the near future, which could result in a negative effect on its stock price. The company currently pays a significantly higher dividend yield than companies such as General Mills or PepsiCo. Below, you can find the Seeking Alpha dividend yield grade for the Kraft Heinz company, which underline the company's attractive dividend, right? And you can see that it gets, lots of A's here. Okay, a couple C's. All right. And when you look at the trailing 12-month free cash flow, and the 5-year yield on cost. But everything else there, we're seeing lots of A's and some B's. Okay, the Kraft Heinz Company's dividend yield of 3.98% stands 62.32% above the sector median, which is 2.45%. Below, you can find consensus dividend estimates for the Kraft Heinz Company. Consensus dividend estimates are 4.01% for 2023, 4.05% for 2024, and 4.11% for 2025. The numbers indicate that the company could be an attractive choice for dividend income and dividend growth investors. The company currently has a PE ratio of 13.48, which stands 48.17% below its average over the past 5 years, indicating that it is undervalued at this moment in time. In addition to the above, it can be highlighted that the company's 24-month beta factor of 0.28 strongly indicates that it will contribute to significantly reducing the volatility of your investment portfolio while helping you to generate extra income in the form of dividends. And you take a look at the projection of Kraft Heinz Company's dividend and yield on cost when assuming a dividend growth rate of 1.5% over the following 30 years. Similar to Kellogg, I would recommend to underweight Kraft Heinz Company in an investment portfolio if you do decide to include it. This is due to its limited growth perspectives. The company has an average revenue growth rate of negative 0.63% over the past 5 years. Now, TD is another one. The Toronto Dominion Bank currently pays a dividend yield of 4.47% and a dividend yield of 4.64%. What makes the Canadian bank particularly attractive for investors is that in addition to the attractive dividend yield, it's shown significant dividend growth in the past years. The bank can not only contribute to help you earn a significant amount of extra income, but it also could increase this amount year over year. The company has shown a dividend growth rate of 7% over the past 3 years and a dividend growth rate of 7.13% over the past 5 years. The bank's valuation is currently attractive since its PE ratio of 10.77 lies 7.19% below its average from over the past 5 years. Furthermore, its price to book ratio of 1.41 lies 27.17% below its average over the past 5 years. The bank has a strong profitability. This is underlined when looking at its return on common equity of 14.66%, which stands 32.54% above the sector median. Moreover, the bank has a net income margin of 31.78%, which lies 23.21% above the sector median of 25.8%. The Canadian bank has a 24-month beta factor of 0.72, which supports the investment thesis that it can further contribute to decreasing volatility of your investment portfolio while providing you with a significant amount of extra income in the form of dividend. And you take a look at the projection of TD's dividend yield on cost. All right, when assuming an average dividend growth rate of 6% over the following 30 years, which is in line with its dividend growth rate over the past 10 years at 6.02%. So the graph illustrates that the Canadian bank is an excellent pick for those investors who want to combine dividend income with dividend growth. Furthermore, it shows you the benefits of investing over the long term. Now, that's pretty much going to be it for today's video. In conclusion, the 5 selected companies we presented in today's article could be able to, provide your investment portfolio with the following benefits. 1 being extra income in the form of dividends. 2, you can increase this extra income from year to year due to the dividend growth it can provide your portfolio with. And number 3, reduce the volatility of your investment portfolio. I consider it important for any investment portfolio to include these kinds of companies that provide stability by decreasing the portfolio's volatility. These companies will help you to sleep better during the next stock market crash. And in addition to that, they help you to understand that you do not need to sell some of your stocks during the next stock market decline. Smash that like button and subscribe to the channel if you guys enjoyed this video. And I'm out.